Yes, so welcome everybody. My name is Lars von Tienen, and I welcome you to my presentation on the topic Time is cyclical, not linear. So we will build nonlinear predictive indicators based on cycles. So this is the part 2, which will have the main issue on Metonic cycles, which I will present to you during the next 30 to 40 minutes. My presentation will include concrete trading details, how to set up these indicators. I will present trading systems and I will show you the performance of these trading system based on statistical verification. You will learn during the presentation how the indicators and trading systems will be set up, and I will give you all knowledge that you are able after this presentation to set up the indicators and trade systems on your own afterwards. So yeah, really follow my presentation and you will be able to build this on your own based on the knowledge you will get during the next 30 minutes. So let's start with the short starting point on to compare what is linear time versus cyclical time. So I think this is the main thing to understand if we want to deal with predictive nonlinear indicators. So first of all, in our current Western world, the dominant way to think about time is a linear way. So we always think time starts at a certain point in time, then progresses onwards step by step, reaches a point in time, and then goes forward, and then time has an end or a special point which follows to end. So it's a very linear thinking about time. But that's not the only way to think how time goes on. The other and also very prominent topic about time, but however it's not present in our Western thinking world, is to see time as cyclical. So what does it mean? So it was mainly favored in the ancient world, like Mayas or Greeks. So, and they have not thought about time in a linear fashion. They thought about time in a cyclical way. So it means that events will repeat based on different cycles. So there's just more than one cycle, but they have not thought about time just having a start and an end point, and between it's linear, just moving forward. To think about time in cycles is that events, that special things in the past will happen again in the future. So there's a cyclical component within time, which has the beauty, so if you know what will happen today, you might know what has happened in the past and what will happen tomorrow. So it's a complete different thing to think about time. So when it comes to technical analysis, the topic that we have to take into account is that in the linear based world, we take the last n bars to rate the present bars. So this is how all classical indicators work. Most indicators have a length setting, and they use the last 10, 13, 14, 15 whatsoever bars to build an average or to build a relative strength index or to build an oscillator or whatever. They always use the last n bars to calculate the current condition for today. So that's the current way how technical analysis in the linear time-based world works. However, if you move over to a cyclical world, then you would think about take the last n bars from the distant past based on a chosen cycle to rate the present bar. So in a cyclical world, it doesn't matter what the last bars from yesterday or so have told us. So then we have to take into account the cyclical component, which may come from the more distant past than just the linear past from yesterday. So just question yourself or think about, why are the current last bars so important to judge the current condition? I mean, all indicators work on this way of thinking. So regardless how sophisticated the calculation or mathematical algorithm will be, they always use the current condition based on the last n bars. So, but why? Why are the last 10 bars so important to rate if the market is oversold or overbought today? Why do we use the last bars to rate what is the situation now? So maybe, perhaps, the bars why days or years back related to a certain cycle are much more important to rate the present condition than the last n bars. So this is cyclical thinking. But nothing of this is available in the current technical analysis platforms we see today. They always calculate based on linear time. So please think about these two different ways to think on. What I want to show you now is why not switch the way in our technical analysis back to cyclical time, and we are not interested in the last bars just from a linear point of view. So the most important question is then, which cycles do we take into account to build cyclical time-based indicators? So this is one major question you have to ask yourself if you want to transform linear-based indicators into cyclic-based, nonlinear predictive ones. So what's the important cycle? Before I introduce this important cycle, I have to go back, and I just can recommend that you have a look on the Antikythera mechanism. This is a device, it's dated 100 years before Christmas, and this device is known that it calculated and displayed statistical information based on cycles. It was used to build calendars in ancient societies, and they predicted agricultural activity and they predicted religious festivals. So this device is just from the very distant past, and it used just cyclical devices here, and it's technical, so complex for at least a millennium afterwards, and the level of engineering in the mechanism is astonishing by any standards. So this device is also called as one of the first computers on our world here, has celestial planetary information to predict future events. And one of the important cycles which was embedded in this device is the Metonic cycle. So what's the Metonic cycle now about? So the Metonic cycle gives you information when the sun and the moon and the earth have the same position before our stars again. So let's assume now we have June 26, 1991. We have full moon, phase 100%. The moon is the yellow dot here in the middle of the screen, and we are looking now from the Earth into the sky, and this will be how the sky would have looked like on the 26th of June 1991. This gray dot here is the shadow of the Earth, so the sun is in the back of us. So now question yourself, when will we have the same planetary configuration from the sun, the moon, and the Earth before our stars again? Now, that's the Metonic cycle. It's exactly 19 years. So if you move 19 years forward to the 26th June 2010, we will have the exact same situation. So here's the moon, here's the shadow of the Earth, which means that the sun is in the exact same configuration, and here we have the stars again in the same configuration. So the moon and the Earth is placed before the stars in the exact same position as it was 19 years before. And there will be no other point in time between these 19 years when we will have the same configuration of the Earth, the Sun, and the Moon in our stars again. So this Metonic cycle, about 19 years, is not only important for today, it was also important hundreds of years before Christmas. So, and it was used by ancient societies to predict events in the future. So there are also two subcycles of 11 and 8 years where we will have a similar configuration in the stars. So these are the three cycles which are important, which gives you the same configuration of the Earth, the Sun, and the Moon before our stars. Why is it important? Why I'm talking about it? The Sun and the Moon does influence our daily life here by the most important things. So we will have our solar system, our sun here. There we will have energy cycles, sunspot cycles, charts, particles, which will come down to our Earth here. And the moon is also there, and it has influences to the magnetosphere and how the magnetosphere interferes with these charged particles here. So this configuration defines how these charged particles come down here to our Earth. And the near-Earth fields, like the Schumann frequencies or Kelvin frequencies, just in the near-Earth atmosphere, then influence our ionosphere here. And the ionosphere, which is influenced by these charged particles, the configuration of the magnetosphere, the near-Earth field, and then this ionosphere has a direct impact on our human body. So the way we feel in the ionosphere will lead to consequences in our human configuration, like mood, fear, greed, and happiness. So there's a lot of research out now which gives us evidence that these geomagnetic variances on Earth caused by the Sun and the Moon appear to affect our human behavior, judgments, and decisions about risk. So this is researched medical evidence today. So for example, pilots experience a high level of anxiety and decreased functionality due to reducing the flying skills during geomagnetic active periods. We also have the double daily number of hospitalization of patients with mental disorder during active periods. Or another example is just that we have 70% increase of daily death rates due to heart attacks for active geomagnetic days compared to unsettled geomagnetic days. And now the important thing is how these variances now come down to Earth is directly dependent on the position on the Moon, the Sun, and the Earth in our stars. So these three planets define how these charged particles will be filtered on the way and the influences within the ionosphere. So now, go back to the Metonic cycles. If you know that every 19 years you will have the exact same position in the sky of these three planets, then you can assume that the effects should be quite similar to our human body. So every 19 years, this grid, or we can call it geomagnetic grid here, has the same configuration. So the configuration of this geomagnetic grid here repeats every 19 years. And this then has consequences how the way the charged particles come down here will influence our mood, fear, greed, and happiness. So now this is a very important cycle here which influences our daily living here. And therefore, let's now use this Metonic cycle of 1911 and 8 years to convert linear time into cyclic time-based indicators. So how does it go? So it's from the generic point of view very simple. So today, at this point in time here, and we say now that today is important to look 8 years back. So how the situation was 8 years ago, how the situation was 11 years ago, so these have been the two subcycles of the Metonic cycle, and how the situation was 19 years ago. So these 3 points in time from the distant past define how the effect will repeat today. So we don't take into account the last 3 days, which you would have done by any indicator like relative strength or oscillator. We take into account the 3 values 8 years, 11 years, and 19 years back to rate the situation for today. And now the best of it is that you can now build predictive indicators which goes into the future now for, in this case, by 8 years. So we can roll forward the complete calculation logic for the next 8 years, because we can rate the day 8 years into the future by the situation of today, 3 years back, and this year's back in this point in time here. So we roll forward, and the shortest cycle defines how long we can move into the future here. So our maximum forecast period is defined by the shortest cycle, and in this case here, by using the Metonic cycles, we can have a linear time trade logic into the future based on cyclical time concept by 8 years. So this makes it quite interesting to build this kind of non-linear predictive indicators. So let's start with a very simple trading system here. First of all, we call it daily sentiment score. And the daily sentiment depends on 19 years back, we had an up day or down day. If we had an up day, we just say the sentiment was positive, and if we had a down day, we just rate the sentiment as negative. We will then also look into the subcycles 11 years back. If it was an up day, we give it a 1. If it was a down day, we give it a -1. And the same for 8 years back. So we get a total composite score for today based on this simple calculation. And this is very simple for you to rebuild on your own. So just calculate these three values, add it up to a composite score. And therefore, now we will get a score for today, which oscillates between -3 and +3 in total. So the trade logic now is the last step to build, and we will keep it also quite simple here in this case. So we will establish a long position if this value is between 1 and 3, so in the upper range. We will stay neutral if we will just be between -1 or +1, and we will establish a short position if we are below -1 and -3. So this is the simple trade system logic, which is also very simple for you to repeat on your own. So let's see how this trade system would perform. To show you here, this is very easy to introduce, and in this case here I've built a TradeStation easy language code on this, where you see this is the Metonic Sentiment Index, exactly calculated as given. You here see the days back, so the 19, 11 and 8 years back are just counted in days. And this just gives you the composite score as just shown today, on the slide before. And the blue bars just represent the situations where we are above 1, so this would be a long trade. And the red ones just visualize the situations where we are below -1 and 3. So these are just the short trades here. So and the light blue ones are the entry signals. So this is the entry for a short here, and this would just be the exit signal as we go back above a -1 here. So this is a short, and then say the same for the long entry here. So the trade logic is then very easy to code into a strategy, which you see here on the TradeStation live chart. And you see that it's this indicator, this screenshot was taken on December 12, where I built this trading system here. And you can see that the indicator plots into the future here. So very easy to implement, also on TradeStation here. The detailed easy language code is included in the plotted description of this what I show here. So even if you won't do it on your own, you can use the easy language code which I provide to you. Okay, so now let's have a look at the results. So this is the equity curve trading this Metonic logic. What you see in blue here is the Dow Jones index from starting 1990 to 22. So over 20 years, we are looking on the period of over 20 years here with this static system. And the red curve seen here is the equity curve, just swing trading our logic here, going long and short based on our rules. What you see here is that trading the Dow Jones based on the Metonic Cycles. So these full trades here is a static system, so all trades for the year of 2000 have been available since 1992, because we can forecast 8 years into the future here. So it's a very simple predictive indicator here, and this Metonic logic even outperformed the index itself. So let's have a look at the trade system statistics here. So we have a profit factor of 1.3. We have 56% profitable trades. We have winning years of 74%. We will have an average annual return about 9%. And if you compare it to the Dow Jones, it's just 8%. So we have a higher average return by just predicting the trades for the Dow Jones 8 years in advance, based on the Dow Jones itself. So it's no high sophisticated indicator here or mathematical calculation. It's just looking into the past 19 years, 11 years, 8 years. Just have a look if it was an up or down day, and we will decide if today will be an up or down day based on the past 3 days. Nothing more, quite simple. And based on this logic, you can outperform the Dow Jones Index itself. So not only that you have the better annual return than just the index itself, the standard deviation is lower. The shape ratio is better, which means that you have a lower risk by having a higher return. And this is now quite interesting, because normally the risk will get larger when having better return rates. So, but the shape ratio here indicates that we get a better shape ratio, so lower risk with higher return. Even the drawdown is just lower, so as seen here. So our systems has a lower drawdown than the Dow itself. And also the time to recover between equity peaks within our Metonic logic is more than only half the length than the index itself. So the Metonic logic is able to build new equity peaks quite faster than the index itself, and was just executing about 27 trades per year, which means that we have 2 to 3 trades a month, which is very easy to trade, so it's no overtrading here. 2 to 3 trades a month is quite easy to execute, and you know all trades in advance, so it's not a very high sophisticated trading system here at all. So and now you can see that this looks quite interesting here. So you don't no linear technical indicator with a static rule set will be able to generate this equity curve for a period of over 20 years. So, but just using this nonlinear indicator, by just looking if it was a positive or negative day based on these 3 cycles, will build an equity system which outperforms the index in mainly all performance metrics here. So this now makes nonlinear indicators very interesting. But however, maybe we just had a good look, and I mean this system was just by chance. So what we need to do for sure is to do a statistical verification on the system I showed you. So the simulation now presents the null hypothesis that the predicted long-short neutral positions generated by our Metonic cycle strategy are just purely random. So we think, okay, it was just pure random luck we had, and we have to check this null hypothesis. So our alternative research hypothesis is that our Metonic logic is so advanced that it can predict positions in such a way to produce superior trading system results. But to accept these research hypotheses, we have to neglect the null hypothesis. So we need some statistical verification. In order to do this, I built I used the same trade system with 3 random cycles. So instead of using 19 years, 11 years, 8 years, I built over 10,000 systems with the same trade logic execution, just using random cycle lengths. So not using the 3 defined cycles which have been set by the Metonic cycles. So even these cycles have not been derived by backtesting and optimization techniques. It's pure natural law. So that's even also important. No backtesting, no back optimization, no curve fitting at all. Pure natural logic here. So however, let's now take our 10,000 systems where we feed in random cycles. So let's look how the statistics would look. So first of all, we will measure profitability. So the percentage of winning trades we had here. So the red areas is just the number of observed systems from the random combination of over 10,000 systems here. So, and what we would expect is the blue line is the expected ideal Gaussian distribution, so the normal distribution which we would expect here. So you can see that our observed systems follows the natural distribution which you would expect, not 100%, but it fits this. So in our Metonic cycle combination is exactly sitting here at this situation. So we had a profitability of 56%, which is a p-value below 0.0%. So it's highly statistical significant that you cannot build this value here based on pure look alone. Let's have a look at another statistical value here, just using net profit of these over 10,000 trading systems here. So within the normal distribution is exactly what you expect. So you would expect the majority of system just trading around zero, then the other one half just losing systems and the other half just winning systems, which generating profit. And again here our Metonic logic has a profit of 14,000 index pounds, exactly sitting at this point here in the normal distribution table. So and this results in a p-value of 0.2, which is highly significant again that the system is not based on pure luck. Let's have a look at the last third verification. Now we use our profit factor of the system of over 10,000 random generated cycle combinations here, feed into the same trade logic here. And this is exactly what you expect. Over 3,000 systems have just a profit factor of 1, which means neither profit, either loss. And then you see our Metonic system has a profit factor of 1.39, which sit at this range here from normal distribution, which is also highly significant and cannot be bought by chance. So the final result, which these p-values from the normal distribution being far below our significance level of 1%, we can now reject the null hypothesis that these performance results have been based on pure luck. So this confirms our hypothesis that these usage of recurring Metonic Doe sentiment cycles leads to statistically significant superior than random Doe trade system performance results. So this is just the very compressed results of my statistical testing. So I give you a lot of more details here on the statistical analysis, which is quite needed in order to get trust in such a nonlinear way. So however, let's move forward. This is just a generic approach. So now, if you can trust it based on the statistical verification, you can build a lot of other cyclic forecasting techniques using nonlinear indicators. So this is an example on the 10-year T-note here forecast, and it's a forecast. What you see here is just the situation from 2008 to 2012. This was a standard linear indicator which has been transformed now into the cyclical logic. So this is the nonlinear cyclical one which you see on the screen. So, but how is it built? It was built before we had the price data. So this indicator score is now just the value of the value 19 years back, 11 years back, 8 years back, and then just divided by 3 to build the average. So this indicator value was built on the indicator value 19 years, 11 years, 8 years back. So we can calculate the indicator values for the next 8 years into the future. So and it does not depend on the price action just today. So what I've marked here, and this is just one way to read it, you would look out for the extremes of this indicator reading. So here we have a high extreme reading, here we have a low extreme reading, here's the next high extreme reading. So you would look out for these areas and would think that these areas would also correspond to major tops and lows in the price action. So let's see how the price now as it was coming into this indicator. As you know, this indicator is not dependent on this data at all. So here we had our expected high range, which depends to this point in time, then going down into this area where we would expect a major low reading, and this corresponds exactly here to this low. Now let's move forward. Here we had this high reading, which corresponds here to this area where we had the high in the market. Then moving down into this area, okay, not an easy one to spot from daily point of view, but you see the low here. Then moving into the next expected major high reading is exactly correlating to this high here in the market. So then the next major low reading here was here, and this also correlates to exactly to the low rating of this market here. So And you now can just go forward. Here's the next high correspondence to this high here. And if you see this kind of high correlation here between indicator reading and price reading, now it gets quite important for you to think to build this kind of nonlinear indicators. And again, you can build this kind of indicator just by adding 3 values from the past, dividing by 3. So I mean, you don't need to be a coder here to do it. It's quite simple with any script language out here. And you see here how directly it correlates to price movements here. But let's move forward. Another way would be to build mechanical trading systems, so pure 100% mechanical trading system, which is what we're mainly looking for. So there's no judgment on an individual basis, no subjective filtering here. How would it look like? Let's start with just a simple one here. So we will use a momentum trading system, which simply means we will sell the momentum tops and buy momentum lows. We will just use a standard momentum indicator here and now compare the linear time-based version against our cyclic time-based version. Let's start with a simple chart here. So this is just a standard smooth momentum indicator here. Which you can have in any charting platform at all, so it's nothing really special. A length setting of 8 and a smoothing factor of 2 just added on top of it. So for sure you see that the momentum tops are mainly correlated to market tops and vice versa the lows here, just marked on the chart. So the simple idea would be that you trade these momentum tops and lows based on the technical indicator. However, you are all aware of it that we have too much lag in our technical indicators to trade this successfully. So we can only identify the signal after the turn here. So market just came down a lot. So the time to enter the short trade here, so price moved down a lot. So this is the problem with lagging indicators at all. But however, let's have a look at the trade performance figures now. So what you will see here is that I feed in all parameter combinations in our momentum indicator. So based on a length setting of 5 up to a length setting of 12, I've checked all combination by just going short at the top and going long at the bottom. So quite simple logic, and just added all smoothing factors here. So the smoothing factor goes from 2 up to 5 and just testing all combinations here. So the interesting point is that all trade configurations get a loss here. So you see the overall loss of this trade configuration, which mainly just one combination just got a small profit here, but I think it's not reliable here at all if you have a look at the accuracy and the win-loss ratio here. So the summary out of it is that just trading pure momentum turns will not lead to profitable trading systems. So just 1 out of 32 trading system was able to generate a profit above 0. So we will have profitable trading system 3%. And this strategy was executed from 2000 to 2012. So over 12 years of data. So no momentum indicator is successful trading in the linear time-based way. Now let's move on to the cyclic time-based indicator. Just repeat. We just calculate now our momentum for today is based on the momentum on the indicator, how it was 19 years back, 11 years back, 8 years back. So the momentum is just the composite of 3 momentum values from the distant past. And now let's trade this indicator, which is predicted 8 years into the future. So you don't have to wait until the bar from yesterday came in. You can do it 8 years into the future. So now this is the cyclic time momentum trading system. Again, I've checked all combinations for the length setting of the momentum and the smoothing factor. So the same comparison here. But now, any trading system here generated a profit. So now this is interesting. Not only 1 or 2 combinations have been able to generate a profit. It doesn't matter which parameter configuration you would have chosen for the length setting or the smoothing setting. Each combination was able to generate a profit in the end. So all parameter combinations have been profitable. So this strategy is not dependent on the parameter setting. Each system was profitable. Same period here, 2000-2012, over 10 years of data. You have an accuracy of over 50%, win-loss ratio of 1.1, 1.2. So this is, again, not pure luck to have a profitable trading system somewhere here. All trading system has been profitable. Just repeat it in your mind, all trading systems. So again, let's have a look at the equity curve. It's not a big bulb at the end or something like this. We see a smooth upsloping equity curve here. So this is the Standard & Poor's 500 index over the period from 2000 to 2012, so the indicator. And this is the equity curve when you trade the momentum indicator, just not based on linear time, in this case based on cyclic time. And we use the Metonic Cycles because there's a natural vibration in it. So, and these cycles have, again, not been detected by over-engineering, optimization, curve fitting, or whatsoever. Just natural law. And if you build the momentum indicator based on cyclic time and just trade the momentum tops and lows, you see how the equity curve will look like. Again, you will have similar distribution statistics as I showed you at the first trading system here. So the drawdown is quite lower than on the index, and here it's a quite constant linear upsloping equity, which is quite an ideal equity curve. Just trading the Standard & Poor's on the momentum of the Standard & Poor's, just on cyclical time. So gentlemen, I hope that you have now been aware of the power of nonlinear predictive indicators. What you have learned by this presentation is just which cycles to use based on the Metonic cycles. So you have all at your fingertips now to build this kind of trading systems, this kind of nonlinear indicators, this kind of predictive indicators, and this kind of trading strategies on your own. The trade logic and calculation is so simple that there's no over-engineered coding needed. So, and finally, let's just have a look and just think about it that if you look at Gann and Tunnel-Fourier, a main publication from W.D.Gann, so then let's have just a review of his last sentence. My calculations are based on the cycle theory, on mathematical sequences. History repeats itself. In order to know and predict the future of anything, you only have to look up what has happened in the past and get a correct base or starting point. In making my calculations on the stock market, I get the past history and find out what cycle we are in, and then predict the curve for the future, which is a repetition of the past market movements. The limit of future prediction based on exact mathematical law is only restricted by lack of knowledge of correct data on past history to work from. So, mainly, you don't have this lack of knowledge now. What I've shown you here is how to build nonlinear predictive indicators. I've shown you statistical verification that was just not pure luck. I've shown you based on the momentum indicator that if you compare the linear trade logic to the cyclic logic, then there's a huge difference. No linear combination was able to build a profitable trading system. All cyclic time-based indicators have been profitable. So hopefully you have been able to get something out of this presentation. Finally, and the good thing is, all what I've now compressed, presented during the last hours is written down in a book. So I don't want anything from you, but there's a book available at Amazon for very low price where you can read all the details I've presented here. So this is a very new book which is out there. And this book has over 240 pages, which detailed written explanation and background on what I've shown here. It includes step-by-step guides to set up and rebuild all these nonlinear indicators and much more. And there's a lot of in-depth statistical verification for all the backtest and probability analysis. So all indicators are presented in generic pseudocode, and I've also included the TradeStation easy language code for the Metonic system, which you have also seen here. So even it's quite simple to build, I've included the full easy language code here. So everybody can execute this on a price chart. And there was some additional video lessons here. So hopefully, please now take this into account for your next trading system. I think it's very valuable to think about nonlinear predictive indicators. Thank you for listening and have a good time.